The fastest way to understand an overvalued suburb is to look at what it was priced to assume. Some places were priced for endless job growth. Some were priced for permanent low mortgage rates. Some were priced for investors to keep buying forever. And some were priced for a migration wave that was never going to last at full speed. In this video, we are counting down 10 suburbs where the pricing story got ahead of reality and the correction is now visible in plain sight. You will hear about the exact pressure points that matter in suburbs, not just cities: new build supply, property taxes, insurance, HOA costs, commute realities, rental demand, and what happens when a suburb becomes a spreadsheet instead of a neighborhood. This is not a prediction that every home will crash. It is a practical map of where the gap between prices and fundamentals is widest and where the bubble logic is breaking first. If you want more data-driven housing breakdowns like this, subscribe to Discover the Nation. Number 10. Winter Garden, Florida. Winter Garden became one of the most chased zip codes in the Orlando area during the rush years. It checked every box that buyers wanted at the time: newer homes, master-planned communities, good schools, and the feeling of being close enough to Orlando without living in Orlando. The pricing moved fast, and it moved as if demand would stay unlimited. What makes Winter Garden stand out now is how exposed it is to the three forces that quietly end suburban bidding wars. First is payment shock. Many buyers in this market relied on low-rate math. When rates stay higher, the same house that felt affordable becomes a monthly bill that crowds out everything else. Second is the new construction pipeline. The region has a constant ability to add supply. When builders offer incentives, rate buydowns, and upgrades, resale sellers become the less attractive option. You can see it in listings that sit longer and price reductions that happen in steps rather than one big cut. Third is the investor share. Orlando is full of short-term rental dreams and long-term rental calculations. When rents flatten while costs rise, investors stop being the extra buyer at the margin. Winter Garden is also sensitive to insurance changes and roof-related underwriting shifts that are more common in Florida. When insurance renewals jump, buyers adjust their budgets down, even if they love the neighborhood. The signal to watch here is not one headline. It is the combination of longer days on market, higher inventory in specific subdivisions, and sellers competing against brand new homes with builder financing. Winter Garden can still be a good place to live, but as a price story, it is no longer priced for a one-way market. It is priced for negotiation again, and that is what bursting looks like in a suburb. Number 9. Castle Rock, Colorado. Castle Rock sits between two economic magnets, Denver and Colorado Springs, and for years that geography made it feel like a safe bet. Buyers believed they were buying into growth from both directions. During the surge, that belief got amplified. Remote work made commutes feel optional. People paid premiums for space, views, and new builds, often assuming they would not need to travel daily. Now the weak point is showing, and it is different from Florida. Castle Rock is a payment suburb. The price points got high, the property taxes and HOA costs add up, and many households stretch to get in. When rates stay elevated, the buyer pool shrinks fast. There's also a second layer here. Wind and wildfire-related insurance pressure in Colorado has been rising in visibility, and buyers are more cautious about long-term cost uncertainty. Even when the premium difference is not extreme yet, the fear of future increases changes behavior. Castle Rock also faces the new build issue, but with a Colorado twist, a lot of the product is newer. That means sellers cannot rely on charm or scarcity the way older neighborhoods can. A newer home competing against a newer home is mostly competing on price and financing. Builders can move inventory with incentives, individual sellers cannot. That's why you often see resale listings chase the market down in small cuts. The other signal in Castle Rock is psychological. In suburbs that run up fast, the first phase of correction is disbelief. Sellers list at yesterday's price and wait. The second phase is urgency, when they realize their competition is not last year's neighbor, it's this month's builder offer and the house down the street that already cut 20 or 30,000. Castle Rock is not collapsing because it's undesirable. It's correcting because it was priced as if remote work would permanently neutralize commute costs and as if borrowing would stay cheap. When those assumptions break, the premium breaks with them. If you're tracking suburban bubbles, subscribe to Discover the Nation because these shifts show up in suburbs before they show up in headlines.
Number 8. Franklin, Tennessee. Franklin has long had a premium brand. It is associated with high-performing schools, a polished lifestyle, and a sense of stability near Nashville. During the boom, that brand turned into a pricing engine. Buyers were not just buying a house, they were buying a label. The problem with label pricing is that it can outrun income reality. Franklin prices surged while Nashville's job growth and wage growth could not keep pace for everyone. Then the market started leaning on newcomers, especially higher-income transplants and equity-rich buyers from more expensive states. When that inflow slows even a little, the market feels it quickly because local affordability is already stretched. Franklin also carries costs that get ignored in excitement. Larger homes mean higher maintenance. Many neighborhoods have HOA obligations that add monthly friction, and Tennessee's property tax structure and assessments can surprise new buyers who assumed costs would stay static. What makes Franklin's correction pattern unique is that it often appears first in the top third of the market, not the starter range. High-end suburban homes depend on a steady stream of confident buyers. When rates and economic uncertainty rise, those buyers become selective. They demand concessions, inspection credits, and price cuts. That is why you may see more listings sitting while sellers insist they are not desperate. Another signal is rental softness in certain pockets. When investors bought in expecting strong rent growth tied to Nashville's popularity, the math looked easy. But if rents level off while mortgage payments are higher, the investor demand turns into investor supply, not always in floods, but enough to change the balance. Franklin will still have demand because the quality of life is real, but it is overvalued when buyers pay for the idea of Franklin without matching it to today's financing costs and real local wage capacity. The bubble bursts here through slower sales, price reductions that start as small and then stack, and a growing gap between list prices and closing prices.
Number 7. Meridian, Idaho. Meridian is a perfect example of a suburb that became a national storyline. The Boise area was treated as a migration miracle. People arrived from higher-cost states with cash, equity, and urgency. Meridian absorbed a huge share of that demand, because it offered newer housing stock, family-friendly neighborhoods, and a suburban layout that felt easy. The risk in Meridian is that it was priced like the migration wave would never cool. But migration waves do cool. They slow when affordability disappears, when remote work rules change, and when the cost advantage compared to the origin state narrows. Meridian's rapid appreciation narrowed that advantage. Suddenly, buyers were not escaping prices, they were meeting them. Meridian is also sensitive to investor behavior. When a suburb becomes famous, it attracts investors who do not know the streets, they know the chart. Those buyers raise prices quickly, but they also leave quickly when the curve flattens. If you see inventory rising and price cuts spreading across similar floor plans, that is often the investor unwind phase starting. A second local driver is income structure. Idaho's wages do not automatically support the peak price levels that showed up during the surge. That does not mean nobody can afford homes. It means the pool is thinner than the listing count suggests. When a thin buyer pool meets a rising supply of similar suburban homes, negotiations return hard. The key signal in Meridian is the behavior of nearly new homes. When people try to sell after only 1 or 2 years, it tells you they bought near the top and now need out for job, family, or payment reasons. Those listings compete directly with builders who can offer financing incentives. That squeezes resale sellers into cutting price or offering concessions. Meridian is not a failing suburb. It is a suburb that got priced like a national brand. Now it has to reprice like a local market again. That transition is the bubble bursting in slow motion.
Number 6. Alpharetta, Georgia.
Alpharetta has real economic reasons to be expensive. It benefits from the North Atlanta job corridor, strong schools, and a high-quality suburban environment. During the boom, those fundamentals merged with a second force: corporate relocations and tech-adjacent growth around Atlanta. Prices ran hard, and many buyers treated Alpharetta as a sure bet. The correction risk here is not about demand disappearing. It is about the premium becoming too large for what most households can pay with current financing. When a suburb reaches a point where only a narrow slice of buyers can qualify, it becomes fragile. Sales slow, inventory builds quietly, and sellers who need to move become the first to cut. Alpharetta is also a suburb where the difference between neighborhoods matters a lot. Two homes a few miles apart can have very different school clusters, HOA obligations, and resale appeal. In a hot market, buyers wave those differences away. In a normal market, those differences become bargaining points. That is when overvaluation becomes visible. Another unique pressure is the cost stack. Many buyers look at the purchase price and forget the full monthly picture. In parts of Alpharetta, you see higher property taxes, HOA fees, and sometimes higher insurance costs due to replacement value. When rates are high, the cost stack matters more than the sticker price. The bubble-bursting pattern in Alpharetta is subtle but important. It shows up as fewer multiple offer situations, more seller concessions, and more listings that return to the market after a contract falls through. It also shows up in the luxury tier, where sellers reduce price in steps while buyers wait for deeper cuts. Alpharetta is still a strong suburb, but when the market prices it as if every buyer is a high-income transferee with a huge down payment, it becomes overvalued. The bursting here is not dramatic, it is mathematical. Fewer qualified buyers plus higher costs equals a slower market and more negotiating power for buyers.
Number 5. Queen Creek, Arizona. Queen Creek represents the far edge of the Phoenix suburban expansion. It exploded in popularity because it offered newer homes, more space, and a lifestyle that felt quieter. People moved outward as Phoenix prices rose. During the surge, that outward move turned into a rush. Queen Creek is vulnerable because it depends heavily on continued in-migration and continued willingness to commute. When fuel costs rise, when remote work shrinks, or when job growth cools, far-edge suburbs feel it first. The buyer who was willing to drive longer for a bigger house becomes less willing when the monthly payment is already high and time costs matter again. Another driver is supply. Queen Creek has room to build. That sounds positive, but it becomes a correction accelerator when demand softens. Builders keep building because that is the business model. When they have inventory, they cut deals. They offer financing incentives and upgrades. Resale sellers then compete with a product that looks newer and comes with a lower effective payment. Queen Creek also has an investor layer, especially around the Phoenix boom narrative. Investors like areas with growth and new construction. But when rent growth slows and prices stop rising, the hold strategy weakens. That can turn into more listings, more competition, and price cuts that spread across similar home models. The signal to watch in Queen Creek is the gap between list prices and the price that actually closes. In a bubbly phase, those numbers converge or even reverse, with sales above ask. In a bursting phase, you get repeated reductions in concessions, and the closing price slides below list more often. Queen Creek can remain desirable for families, but as an asset story, it got priced for endless expansion and endless newcomers. When the market becomes selective, far-edge suburbs lose the bidding war advantage, and the bubble starts leaking through inventory.
Number 4. Gilbert, Arizona. Gilbert is one of the clearest examples of a suburb that turned into a brand. It is known for safety, schools, and polished master-planned living. During the rush years, buyers treated Gilbert as a must-buy suburb, and prices ran as if demand could only rise. Gilbert's risk today is the size of the premium compared to nearby alternatives. In a hot market, people pay premiums without thinking. In a normal market, they compare. They ask what else they can buy for the same money. That is when overvaluation becomes visible.
Gilbert also has a heavy concentration of similar housing stock in certain tracts. When many homes share comparable layouts, the market becomes a direct competition arena. One price cut can reset the neighborhood. That is why bursting suburbs often show clusters of reductions rather than isolated ones. The other driver is the suburban cost stack again. HOA, property taxes, and maintenance for larger, newer homes all add up. When a buyer is already paying a high mortgage rate, those extra costs reduce the maximum price they can offer. Sellers who bought during the peak may resist at first, but if they need to move, they become the first to accept the new market reality. Gilbert is also sensitive to the broader Phoenix cycle. When Phoenix cools, the suburban halo cools. If job growth slows, if in-migration slows, and if builder incentives increase, the premium suburbs see the change in buyer psychology quickly. Buyers start to expect a deal, they start to wait. Waiting is the enemy of inflated pricing. The bursting pattern in Gilbert is often not a crash, it is a reset. It is a move from fast sales and strong bids to slower sales, more negotiation, and more emphasis on condition in upgrades. In an overvalued suburb, a reset can feel dramatic because it removes the emotional confidence that supported the premium. If this kind of suburb-by-suburb breakdown helps you, subscribe to Discover the Nation.
Number 3. Lakewood Ranch, Florida. Lakewood Ranch rose with the Sarasota-Bradenton boom. It became one of the most chased master-planned suburban zones on Florida's Gulf Coast, built for the buyer who wanted newer homes, clean community design, and the feeling of a polished lifestyle, while still being within reach of jobs and beaches. During the rush years, the assumption was simple. Demand would keep flooding in, and the ranch would keep absorbing it without resistance. Lakewood Ranch was priced for that assumption. The bursting risk here is tied to supply and the suburb spreadsheet effect. Lakewood Ranch is built around growth phases. That means the market never fully runs out of inventory. When demand cools, supply does not pause. It keeps arriving. Builders can offer incentives that resale sellers cannot match: rate buydowns, closing cost credits, upgrades, and fresh inventory that looks cleaner than a lived-in resale. That creates quiet downward pressure on resale prices because the buyer compares the monthly payment, not the listing description. The second pressure is Florida cost stacking. Insurance changes are not theoretical here. They show up in renewals and they show up in underwriting. Add HOA fees, community assessments, and higher replacement cost coverage because many homes are newer and larger. The monthly total becomes the real price, and when that total rises, buyers adjust their maximum purchase price down even if the neighborhood still feels desirable. The third pressure is investor math. Areas like this attract investors because the product is new, the brand is strong, and the rentals seem easy to underwrite. But when rents flatten, while taxes, HOA, and insurance rise, the spreadsheet stops working. Investor demand turns into investor listings, not as a dramatic wave, but as a steady increase that adds competition and forces more price reductions. The signal to watch in Lakewood Ranch is not one headline. It is the combination of rising inventory across similar floor plans, longer time on market, and resale sellers competing against builder incentives. Lakewood Ranch can still be a great suburb, but it is no longer priced for a one-way surge. It is priced for negotiation again, and that is what bursting looks like in a master-planned suburb.
Number 2. Round Rock, Texas. Round Rock is not just an Austin suburb. It is a major node with its own employment base and a long history of demand. That is exactly why overvaluation can happen here. When a suburb has real strengths, buyers assume the price cannot be wrong. Round Rock's surge was powered by a mix of relocations, tech optimism, and the belief that Austin area growth would remain unstoppable. The issue now is that the price level reached a point where the monthly payment becomes the gatekeeper. Even if the suburb is strong, buyers still have to qualify. Round Rock also faces heavy competition from nearby suburbs with similar schools and similar housing stock. When the market cools, buyers shop harder. They compare property tax bills, they compare HOA costs, they compare commute times, they compare neighborhood age and maintenance. That comparison pressure reduces the ability of any one suburb to hold a premium. A unique pressure in Round Rock is the difference between established neighborhoods and newer developments. In newer areas, builders can influence pricing through incentives. In older areas, sellers rely on scarcity and maturity. In a hot market, that works. In a normal market, incentives can pull buyers away from resale, forcing older neighborhoods to cut price or upgrade aggressively. The bursting pattern in Round Rock is often seen in the mid to upper mid price tiers. Entry-level demand can remain, but the stretched buyer segment disappears when rates stay high. Sellers in that tier often need the next buyer to be both high income and confident. When confidence declines, those listings sit. Round Rock is not doomed, but it was priced for a perfect continuation of the boom. When the market returns to normal math, the premium compresses. That compression is what many people call a bursting bubble, even when the suburb remains fundamentally desirable.
Number 1. Frisco, Texas. Frisco became one of the most famous boom suburbs in the country. It represents the modern high-status suburb, new schools, new infrastructure, corporate campuses nearby, and a fast-growing population. During the surge, Frisco prices rose as if there was no ceiling. What makes Frisco number 1 is the way multiple risk layers stack together. The first is the price level itself. Frisco moved from being expensive to being priced like a luxury market for many homes. That creates fragility because luxury buyers are optional buyers. They can wait, they can rent, they can buy elsewhere. When optional buyers stop bidding, the market slows fast. The second layer is property taxes. In Texas, taxes can feel like a second mortgage. When a buyer looks at a high purchase price and then sees the tax bill, the affordability ceiling drops. Sellers who ignore that reality end up chasing the market down through reductions. The third layer is supply competition. The Dallas area has an enormous ability to build and expand. Frisco itself is more built out than it used to be, but the surrounding area continues producing alternatives. When nearby communities offer similar homes at a lower price, the premium suburb has to justify itself every time. In a hot market, it does. In a cooling market, that justification weakens. The fourth layer is investor expectations. Boom suburbs attract investors who expect constant appreciation in rising rents. But if rent growth slows and carrying costs rise, the investor math breaks. Even a small shift from investor demand to investor listings can change the balance in a suburb where many homes look similar. The signals in Frisco include more price cuts on higher-end listings, more concessions, and more negotiation. The most important signal is psychological. When sellers stop assuming a quick sale and start preparing for months of competition, the market has already changed. Frisco can remain one of the strongest suburbs in North Texas, but being strong does not mean being correctly priced. A suburb can be great and still be overvalued. When the market corrects, the most overvalued suburbs feel it first because the premium was built on momentum, not just fundamentals.